Bank of Canada has cut its interest rate by another 25 basis points, but Governor Tiff Macklem sending some strong signals that this may be the end of this cutting cycle. Joining us now to discuss, Andrew Kelvin, Managing Director and Head of Canadian and Global Rates Strategy at TD Securities. Great to have you back on the program.
Thank you for having me.
Strong indication here. I know this was the call from TD Securities heading into this. We get a 25 basis point cut, and that's it. That's the end. They've hit their terminal rate. He's indicating pretty strongly there. What would it take to move them off that sideline?
Yeah, I will say I was a little bit surprised they were as explicit as they were about expecting that they are done with the easing cycle at this level. I would have thought they would have been a little bit more cagey about it, maybe preserve a little bit more optionality for future meetings. But I think the fact that they were so transparent about how they're viewing the future policy path tells you that there's a very, very high bar for them to cut rates again in December. Presumably, this has some sort of relationship to the upcoming federal budget, which is expected broadly to be stimulative, and it would make sense if you're the central bank to not be easing immediately after a rather stimulative budget. Now, in order to get them off of this hold that they've sort of communicated they're in, the answer is really simple. The governor was saying that if conditions change, they will reevaluate their path, which is what you would both hope and expect. December, I feel pretty comfortable with the idea that December is a hold. They would not have been as explicit in their communication if they thought there was a reasonable chance of a December cut. And again, it has that sort of proximity to the budget. Even January, it's not clear to me that we're going to have a good indication as to what the stimulative impacts of that budget will be. If the economy's flagging a little bit in January, we will still have the potential boost coming from announced stimulus into 2026 to sort of comfort policymakers. But if we get into the spring, so I'm really looking at March, April, June meetings, and growth is not above its trend rate, if we're still seeing excess capacity in the economy grow, at that point, the Bank of Canada, I think, will have to reconsider if this is, in fact, the floor for interest rates in this cycle. And if it turns out that the drag on the economy from the trade dispute with the United States is a little bit worse, if trading conditions with the United States become worse than they are today, that would be something that would cause them to reconsider. And when I say worse than they are today, I'm not talking about just that sort of presumptive 10% additional reciprocal tariff. I'm talking about something that's more broadly punitive for a wider swath of the Canadian economy.
Seem to be in a bit of a tough place as they are recognizing, of course, that they can't solve a trade war just through monetary policy. But sometimes a trade war can send prices higher, but a weaker economy, they think all of that weighs out, keeps prices in check. Are they being a little too optimistic on inflation being contained, considering everything we're facing?
The reason, I think it's actually a very reasonable set of forecasts they have, and I'd say that on both the growth and inflation side. We can't solve a change in our trade relationship with monetary policy. What monetary policy can do is smooth that adjustment. It can make that adjustment less painful, which is why these sorts of moves are appropriate in my mind. In terms of how inflation is going forward, I think the reason why I'm pretty comfortable with the idea that inflation will be contained around 2%. I never want to put a firm 2.0 so somebody can point their finger at me and say if I'm wrong, it's 2.1. To me, a perhaps overlooked thing in the sort of structural changes the Canadian economy is going under right now is the change in population growth. We had obviously very strong population growth in recent years, which is one of the factors that help contribute to rising rents, rising shelter prices broadly. If we're going to remain in an environment where population growth is very, very weak, close to zero, we shouldn't have those same upward pressures on shelter prices. We shouldn't have those same upward pressures on rents. And shelter is a huge part of the CPI basket. So if we're going to be in an environment where population growth is very weak, that should prevent runaway shelter price inflation. And that in and of itself should be enough to keep inflation around 2%.
Now, you mentioned the structural changes that we're undergoing because of the trade tensions and how the relationship's probably not going to be the same going forward. Well, it's not the same right now with the U.S. Governor Macklem mentioned it as well. Once we get through these structural changes, what does our economy look like on the other side?
So it's probably an economy where the level of activity in the economy is just lower than it otherwise would have been. The way I tend to think about these things is you have a drag on growth in year 1 and 2. And even if you see growth return to its previous levels, you still have this sort of permanent gap between where the level of activity could have been and where you are now. And additionally, they did highlight that they look at these changing trade relationships as something that will drag on potential GDP. So having weaker terms of weaker trading conditions, weaker ability to trade with the U.S., more less open market access is something that will drag potentially permanently on Canadian growth in their mind. So they see us sort of transitioning to a lower growth economy due to the fact that we will have less open trading conditions with the U.S. going forward, just assuming that the current conditions move forward. If we are able to strike some sort of a grand bargain and go back to the world the way it was in November, just in terms of what the actual tariffs charge are and what the actual market access is, obviously a lot of that drag sort of disappears and we can sort of return to that previous economic trajectory. One point I would just make, though, is one of the values of a trade deal is it provides certainty. Businesses can look at the trade deal, trust that the terms of market access will remain constant, and make investments and decisions with the long term in mind. Going forward, even if we get a deal in the next day, week, month, quarter, year,
We got
whatever.
a deal under the first Trump administration, right?
So, pick your time horizon. I don't think people will be quite as willing to just accept that this will be a long-term deal, which they were in the first USMCA. I think when the first USMCA was signed, people assumed that that deal would hold. And I'm quite certain, I probably came on your show and said in 2024, it's like, well, Donald Trump signed USMCA 1, so surely he won't tear it up. And then, fast forward to today, and he has, largely moved away from that deal. So it is something where we probably never fully unring that bell. It probably does speak to an economy where, absent other positive developments, we're in a bit more of a slow growth environment, which is probably why you see the federal government so focused on taking measures to boost productivity.
Let's talk about that. I mean, that puts a lot of pressure on next week's federal budget, doesn't it, to show us something that this economy needs. What do we need to see from that budget?
The budget is probably having too much asked of it at this point. The federal government's in a fairly enviable position, just in that 15 to 20 years of reasonably responsible fiscal policy in Canada mean that the governments, over the last, in the post-pandemic era, have had a lot of fiscal room. Like our net federal debt to GDP is quite low, so this government can come out with a 2.5% budget deficit as a share of GDP without really roiling markets. And I think markets are quite positioned for what could be quite a large deficit in this upcoming budget. The problem I think the government faces here is that a lot of the measures that they would like to take to boost productivity, cutting red tape, like their first signature bill they passed when they came into Parliament before the summer recess was about streamlining projects of national importance. And that's all well and good. Like cutting red tape is all. I've never heard an argument for red tape. I'm sure it exists, but no one's ever said it to me. That sort of effort is the sort of thing that can pay dividends down the road. Cutting approval timelines to make sure that shovels can be in the ground within 2 years or 5 years or whatever the time frame is a great thing that can help boost productivity and growth once those shovels start hitting the ground and once the project's complete, whether it's a mine, a port expansion, a nuclear plant, what have you. The problem is I don't see how any of these things are terribly helpful in 2026. So I think the real task for this budget is they have to balance sort of three things. They have to balance setting the stage to actually boost future productivity growth. They need to take some measures to fill the sort of gap in aggregate demand that is going to persist into 2026. Because I think if the government comes out and their entire budget is focused around measures to boost activity 4, 5, 6 years down the line, again, thinking long term is great, but it doesn't help the economy in 2026.
People want to see something right now.
So they'll need something to help sort of bridge that gap between when these long-term capital investments start to produce growth and the sort of trouble the economy is facing and adjusting right now. And the third thing they'll need to do is probably follow through a little bit on some of the spend less parts of their slogan. They have talked about cutting the size of the civil service, reducing operating costs, whether it be through more use of technology or reducing consultants, whatever the mode they do is. they have to balance all these three things, and they don't all sort of pull in the same direction. There's a balance between you want to invest for the long term or the short term. Do you want to spend for the long term or the short term? How much new spending do you want to have that is effectively offset by operating cost reductions? Because there is no free cost cutting. Anytime you reduce operating costs for a government, like that does have negative implications for the economy. Maybe it's not one for one, but there is no there is no pure dead weight that can just be cut here.